New edition of Markets and More with Sunil Singhania, and as promised on our social media platforms and again to our viewers, Sunil is ready. Sunil, fantastic to have you back. Thank you for joining us.
Thank you.
Sunil, you cannot complain in this market because this market has obliged everybody. Large cap investors have made money, mid cap investors have made money, small cap investors have made money, and micro cap investors have made money. I'm sure your investors are also very happy. I was looking at your returns. But where do we go from here is a bigger question.
Thank you and good morning, Neeraj. I think you're right. Markets have been, very surprisingly quite buoyant over the last 15, 18 months, despite the challenging times during pandemic. And I think as we speak, what is also happening is that the fundamentals are sort of also catching up. So it's not that we are in a, over exuberance kind of space. Yes, there are obviously quite a lot of tips floating around. I always say this, that, this WhatsApp research and Twitter researches are also causing some obscure stocks to move up and down. But by and large, I think the earnings trajectory seems to be pretty decent. We have a good tailwind in terms of, the economy looking like doing much better. And obviously, for a change, we also have the animal spirits from Indian entrepreneurs in terms of, growth and capex coming back. So I think all in all, looks to be pretty decent, even going forward. The only caveat would be that don't extrapolate last 3 months or 6 months or 1 year returns and presume that these kind of returns are going to continue. You'll have to mellow down your returns or return expectations. But I think we remain optimistic even going forward.
One moving part is the US 10-year paper, 1.3 from 1.65 to 1.3. So are US bond markets telling us that economy will slow down or inflation will come down? Because whichever way things are, if commodity prices come down, that's bad news. If growth comes down, that's also bad news.
So, very funnily, if you track the news headlines, when the yields are moving up, people are very worried that this is going to, lead to interest rates going up and therefore a slowdown. And now when interest rates have fallen in the US, people are, extrapolating it as a sign of slowdown. So frankly, I'm not an economist. I don't understand this. What I understand is that at this point of time, there is excess liquidity for whatever reason, and that excess liquidity is going to continue at least for the next few years. Central banks all over the world are very clear that they can't afford to tighten the economy too much because we are still not, roaring in terms of GDP growth. I'm talking about global GDP growth. And I think in this kind of a scenario, this risk on will keep on happening intermittently. From our perspective, what we expect is yields across the world to be stable around these levels, plus or minus, 10, 20 basis points here and there. And I don't think you should read too much into only one or two indicators, because time and again, equity markets have told us that, there is no one-on-one correlation with any one or two indicators. The same thing kind of happened in 2003 to 2008, where interest rates were going up and the economy kept on firing. So it's I would say factor to track, but it would not be the only factor would determine the future as far as the equity market trend is concerned.
So what will determine the near-term direction of the market? Will it be flows? Will it be earnings? Will it be valuations?
So Nikon, it's going to be a combination of all of them. I think we're in this world which is very connected, and there are a lot of new investors which have come in. Obviously, Newsflow is very dynamic. Every investor or trader gets the same news at the same time and wants to react in the same direction almost instantly. And therefore, I would say we are in a higher volatile world. At the same time, as I mentioned to you earlier, there is a good tailwind. So, we always say that the markets have, gone up 100% from the bottom. But actually, if you see January 2020 to now, we are up like 25%. And if you actually see March 21 EPS for Nifty, it was expected to be down by 30%. It ended up being up by 15%, which was highest in the last 5 years. So, I think we are not exorbitantly priced. Yes, we are 10%, maybe 12% higher than the long-term average, but we are not exorbitantly priced. At the same time, going forward, at least for 22, earnings trajectory should be very strong. Combination of a few things. One is we had a very, very challenging June 20 quarter. So that base effect itself will lead to an earnings growth of 15-20% for this year. And then, the earnings this year are also more broad-based. So rather than only the 3-4 sectors like IT, pharma, and consumption firing, this time we have also the economy sectors like steel and cement and capital goods and so on and so firing. So it's more broad-based. I think the problems on NPA provisioning as far as banking sector is concerned have reduced quite significantly. And therefore, that sector also should contribute handsomely to the earnings. On top of it, you also have now attempt by the governments all over the world to spend on infrastructure. And particularly in India, you have this PLI scheme and also the advantage of exports booming because of a shift away from China to some extent. So I think the GDP growth rate also looks good. The last thing is the flows. We have seen huge flows, huge interest in India. Maybe it's the secondary market, maybe it's the FDI, maybe it's the startups or the new age businesses. But that money also helps in GDP growth. And the last thing is a forecast for a normal monsoon. I think the third and the fourth year in succession. So I think it's a good potent combination of things looking pretty decent. At the same time, news flow is going to be very important. We don't know whether this third wave, fourth wave, when that will happen. The only thing is that, the first news of event is always having more impact. The same news does not have as much an impact. But having said that, if this is something which we have to keep a track on, and if things go out of hand, then there might be some impact as far as markets are concerned. So at this point of time, I think we are in a decent kind of a situation, and all these factors have to be tracked to determine the future movement. The only caution again, which I would highlight, is that stay away from this WhatsApp and Twitter research, because almost every stock or every second stock is hitting upper circuits, and I think that is something which we have to keep an eye on.
Sunil, you've looked IT stocks in the past. They've done well. IT companies, if I look at Accenture numbers, double-digit growth is here to stay. But how much of that is in the price? Because IT companies will grow, IT companies will do buyback, IT companies will grow into double-digit, digital is here to stay. That's available on perhaps all WhatsApp groups and Twitter.
So you're right, IT services has done well. And you're also right that everyone expects them to do well. At the same time, I think the potential for this segment going forward is going to be great. The only thing is the companies which might outperform will keep on changing. Even in this sector, Nikunj, the mid-cap ITs or the smaller IT companies are now trading at significant premiums to the larger companies. I don't know what the reason is, but maybe the retail investors are more interested in the smaller companies. And that is where we feel, again, a hint of caution here. There are some mid and small cap IT companies which are trading at, some crazy 80, 90 P multiples, whereas the large caps trade anywhere between 17, 18 to 25 P multiples. It's a good sector. The ISG report which came in was pretty optimistic. I also read a report which talked about software as a service industry in India going to become $1 trillion. India and Indian companies have global competitiveness as far as the sector is concerned. And therefore, our view would be that this would be a good sector to, consistently compound. It's a sector in which companies have huge free cash flows, high return on equity. And I would play the IT sector rather than playing the consumption theme where for similar or lower growth rates and similar ROEs, you are paying maybe 3 or 4 times the valuation which you pay for IT companies.
When you see a Zomato IPO followed by Paytm and somewhere Policybazaar and Nykaa, is that indication of a big sector which is getting created and where a conservative investor like yours will say, look, I find it expensive, or this is a sign of a true bubble?
So see, these are new age businesses, and I think all of the names that you mentioned, hats off to them and their entrepreneurs for creating such businesses out of nowhere. These are businesses which did not exist, and I think the entrepreneurs have to be applauded for creating these businesses, giving employment to hundreds of thousands of Indians, and also sort of making life easier for a vast number of consumers. Yes, these businesses will have to be valued a little differently. They are still in the phase where they are burning money. Though in some businesses which you mentioned, some names you mentioned, you have started to see operating profits in the positive. But it would need a little bit of a different mindset for investors to log in big time into these businesses. Obviously, people like me are a little bit conservative. So let's see. I would not say that these businesses are a bubble. There is always a case in the market where valuations will be either undervalued or overvalued. So maybe, some conservative investors might feel that these companies are coming at a slightly over valuation. But I think, the proof of the pudding is in the eating. As I said, the investors who would want to invest in these businesses would be slightly different investors who are looking at high growth, and eventually profits will come. But I think it's good from an Indian market perspective. You are going to get a wider choice. You are going to get businesses which are globally well understood. And these huge IPOs will also bring in new funds and new sets of investors from all over the world who would want a piece of these companies. So I think all in all, it would only broaden the scope of the market and the choice for investors.
You bought a lot into steel stocks, Sunil. Is that trade here to stay? When I'm trying to say steel, I'm referring to commodities also.
So again, even last 4 or 5 years or maybe longer, there was no major capex or capacity creation in either ferrous or non-ferrous metals. If you take steel, it was predominantly Tata buying a SIG company and ArcelorMittal buying SR or JSW buying some company. But no greenfield major expansion happened. And I think as we progress, these are commodities which cannot be replaced by I would say disruptions. You need steel. And on the other hand, you also have a scenario where, central banks have pumped in so much money and the governments all over the world want to spend that money on infrastructure, where again, steel is going to be, or metals is going to be a big component of consumption. And on top of it, as I mentioned earlier, private capex is also coming online. So all in all, you are seeing a scenario where demand is increasing. Supply has not gone up. It will take some time for supply to come in. And you also have this scenario where the whole world wants to now move to a zero carbon regime. And therefore, polluting industries and polluting, I would say, facilities would be either closed down or will have to pay a big penalty, if they sort of resort to, spoiling the environment. So I think we are looking at this strength continuing. The prices might be volatile because China in almost all of these commodities is 50-60% of the consumption, and what China does might impact in the near term. But I think overall we remain quite optimistic. The other thing which has happened is because of this bumper 1 or 2 years, the balance sheet of almost all these companies have transformed quite dramatically. So interest cost, which used to be maybe 20, 25, 30% of the operating profit, would have fallen quite dramatically. They have become very strong in terms of their financial leverage, and therefore we remain quite optimistic. The only thing is, for a diversified portfolio manager like us, we try to restrict the percentage allocation to the cyclicals, because as I said, these are very highly dependent on what China does, and you don't want a scenario where you have 30-40% of your portfolio dependent on some news flow which might hit you very badly. So positive, but maintain a reasonable sort of allocation to these sectors.
I'm going to ask you a difficult one, Sunil. A year from now, on a scale of 1 to 10, let's assign a probability. What is the probability of this market giving a double-digit return from here? 1 year probability. Whether we reach there or not, there are a variety of factors, but based on probability.
So, Nikunj, you know what my answer would be. I'm a hardcore equity person, and I have always been optimistic on India, and it has been beneficial for me personally as well as professionally. I would still say that 1 year from now, our expectation is 8 to 10% CAGR return for the large caps, and for the broader markets anywhere between 13, 14 to 17, 18%. And that is largely a function of the underlying profit growth which we see in these segments. So, that would be my answer to your question.
All right, Sunil, really appreciate your time. Thank you for joining us. I know we started slightly
Pleasure.
late
Thanks
today.
a lot for having me.
I really appreciate your patience.